Absolutely. Thank you so much for having me, Stephanie and Robin. My name is Lisa McEntee. I am underwriting counsel for First American Title Insurance Company. I work out of our King of Prussia office. First American is the underwriter company for Cross Keys Abstract and Assurance. So when Cheryl says, I need to check with the underwriter, I'm one of the attorneys that she's calling. Today, it looks like we're using a GoToWebinar platform. I believe you're in listen-only mode. Is that correct, Stephanie?
Correct. They're all in listen-only mode. I have two people in the classroom here with me. We can open mics, but I'll also take questions. I'll keep the chat open. And Lisa, you don't have to worry about the chat. I will. I'll direct the chats, back to you.
Perfect. So if you have questions, feel free to input them, or interrupt me, Stephanie, with anyone's questions during the presentation. I don't mind that at all. That's perfectly fine. But we can go ahead and get started. I really appreciate the opportunity to be able to speak with a group of realtors about the new rule that's coming down and taking effect on August 1st. This presentation that I have set up here is dedicated specifically to real estate professionals. What I'm going to do today is talk about, first, a little bit of background where the rule came from. Then I'm going to get into some nitty-gritty details about the rule that will affect you. And the last segment of the presentation will relate to what you as real estate professionals need to keep in mind in order to make your transactions continue to run smoothly after August 1st, after the loan application starting on or after August 1st. So with that said, let's take a look at some background history here. In response to the Great Recession, also known as the mortgage meltdown in the late 2000s, Congress passed a law known as, the full name of which is Dodd-Frank Wall Street Reform and Consumer Protection Act. And that's basically changed the financial regulatory environment that affects all federal financial regulatory agencies and almost every part of the nation's financial services industry. The Dodd-Frank Act creates the Consumer Financial Protection Bureau, which is better known as the CFPB. It directed the CFPB to integrate mortgage disclosures that are already in existence under the Real Estate Settlement Procedures Act and the Truth in Lending Act. So right now you have an early and final TIL under the Truth in Lending Act, or TILA, and you also have a GFE, good faith estimate, and a HUD-1 settlement statement under RESPA. What this new rule did, and it's also known as the TILA-RESPA Integrated Disclosure Rule, or TRID rule, what this rule does is it combines the early TIL and the GFE into one document known as the loan estimate, and it also combines the final TIL and the HUD-1 settlement statement into the final document known as the closing disclosure. So it creates two new forms that really aren't, they're new in the sense that these are the only forms relating to the transaction. Instead of 4 forms, we now have 2. Okay? This all is going to take effect as of August 1st, 2015. So let's get into who provides both of these documents. The loan estimate is provided by either the lender or the mortgage broker. Some lenders are now saying that they're not going to allow mortgage brokers to bind them with the loan estimate, but if they are still allowing them to do that, then the mortgage broker can issue the loan estimate. Otherwise, the lender issues the loan estimate. The closing disclosure is going to be issued by either the lender or the settlement agent. Much like I just said, as far as the mortgage broker is concerned, some lenders are not going to allow settlement agents to create and distribute the closing disclosure. They're going to keep it in-house and do it themselves. So it's totally going to depend on the lender how the loan estimate and closing disclosures are going to be prepared and distributed to the consumer after August 1st. And the reason for this is that the lender is responsible for the accuracy of both forms. So regardless of who prepares it, so if the mortgage broker is preparing the loan estimate, the lender is responsible for it. If the settlement agent is preparing the closing disclosure, the lender is responsible for it. So some lenders are just saying, well, we want to do it ourselves then, and some are saying, well, we're just going to leave it at the status quo. If the mortgage broker is issuing a GSE today, and the lender wants to continue that process, then a mortgage broker will be able to bind that lender with a loan estimate. Similarly, if a settlement agent is issuing a HUD, preparing and distributing the HUD-1 settlement statement today, the lender may allow the settlement agent to continue to do that. So how does this change the game? Totally. There's new timing requirements for the new forms, and this is where you need to be aware as real estate professionals. The timing stuff is going to affect you. Like today, like in today's current climate, the good faith estimate has to be issued by a lender within 3 business days of application. Application, though, the definition of application has changed. And actually, I think that Stephanie provided you with some materials in advance for this, and there is a glossary of terms. So if you're not positive what I'm talking about for any of these things, if I'm using a term that you're not sure of, first of all, you can always interrupt me and ask me, but if not, it may be found in that glossary of terms. Application is included in that. What an application is now under the TRID rule is if the consumer provides the lender with the following 6 items, it will constitute an application. That's name, monthly income, social security number, property address, estimated property value, and proposed loan amount. Once the lender receives those 6 items, the lender is obligated to produce a loan estimate within 3 business days of receipt of the information. Multiple loan estimates may be issued depending on the circumstances. So for example, if the borrower applies for several different loan programs, you know, fixed rate or variable rate, FHA or conventional, that kind of thing, the lender will issue a loan estimate relating to each of those products. Also, the borrower has the ability to shop around to multiple different lenders for the same product. So they may go to one lender and get a loan estimate and then be able to compare it and shop with another lender for the same product and decide which one is better to suit their needs. Loan estimate has to be distributed 7 business days before consummation. Consummation is a new industry term for us. It's old for the lenders. Lenders have always had this term under the Truth in Lending Act, but the title side and real estate professional side, this is a new concept for us. Consummation in Pennsylvania will be really closing. That's what we're talking about. What the CFPB says is that consummation means the day that the borrower becomes obligated to the lender under the note. For our purposes, that usually happens when the borrower signs the note at closing, but it may be different than when the borrower becomes obligated to the seller. Or in other states, you know, Pennsylvania is one of few states that has still wet roundtable closings. In other states, title and escrow are bifurcated, and actually I think the majority of states in the country, title and escrow are bifurcated, so consummation may mean something different in a different state. For our purposes, when I say consummation, I mean closing, and I may use those terms interchangeably throughout this presentation. So that was a loan estimate. Closing disclosure has to be provided and in the borrower's hands 3 days before business days before consummation. A lot of lenders are saying that they're going to mail the closing disclosure as opposed to emailing it or overnighting it or hand delivering it to the consumer. If the lender does use regular old mail, they can add 3 business days for presumed receipt. That means that if the lender places it in the mail on a Monday, then they have to wait 3 days, and that Thursday they can presume that the borrower received the closing disclosure. They don't need to get anything back from the borrower to confirm it. Under the rule, 3 days is enough for deemed receipt. Okay? And that goes for the loan estimate as well. A lot of lenders are saying they're going to mail it also as opposed to emailing it, because when lenders email anything, any of these things are subject, any of these disclosures, they're subject to a separate regulation known as the Federal e-Sign Act. And that means that what I know about it is that it makes life a little bit more complicated for the lender. So, for example, if the lender were to email a loan estimate, the first thing they would have to do is send a test email to the consumer's email address. The consumer would then have to come back to the lender and write an email back saying, yes, this is this is a good email address, I received that. Then the lender would have to send out a test form, like an attachment, PDF, for example, a test attachment form, and then it would come back, the consumer would come back and say, yes, I received that. Then the lender can send the actual document, so the actual disclosure, either the loan estimate or the closing disclosure. So a lot of lenders are saying, we're not going to bother with that because it's too complicated and there's too much room for error, so we're not going to do that, we're just going to send it in the mail. Some other lenders are saying, okay, we're going to use overnight delivery, and the signed receipt will be sufficient for us to presume that the borrower received it. If they do that and they take that and they get proof of early delivery, they don't have to wait those 3 business days to prove receipt, okay? But if they're just sending it in the mail and they're not asking for anything back from the borrower, then you have to wait 3 additional days to presume that the disclosure was received, okay? Now, the new rule places new penalties on there. This is also how this changes the game for TRID non-compliance. Here on this slide, you can see that the CFPB can levy substantial penalties that are going to cause the lenders to be very cautious now come August 1st. So it's up to $5,000 per day for any violation of a law, rule, or final order or condition imposed in writing by the CFPB. Up to just to point out, $5,000 a day for human error. So today, if somebody messes up on a HUD, it doesn't really matter. Nobody's going to sue the lender for failure to complete the HUD form, and there's no government, the CFPB or any other government agency is not going to be able to come in and levy fines under RESPA for incorrect completion of the HUD. That's totally different. So RESPA doesn't have teeth, but the TRID rule does. Okay, so just a plain mistake could cost the lender $5,000 per day. Likewise, it's up to $25,000 per day for any person that recklessly engages in a violation of federal consumer financial laws, and up to $1 million per day for any person who knowingly violates a federal consumer financial law. All right. Not only that, but under RESPA, there's no private cause of action. Under the TRID rule, there is. That means that if there is a mistake, not only can the CFPB levy these fines against the lenders, but the borrower can also sue the lender. The borrower can sue the lender and ask for punitive damages. All right, so lenders they're taking this seriously, or at least they should be. And I will tell you, and I'm not trying to scare you because this really isn't your problem, this is the lender's problem, that the CFPB is not shy about enforcement actions. If you go onto their website right now, consumerfinance.gov or cfpb.gov, takes you to the same place. There is a tab there that allows you to look at all of the enforcement actions that have taken place. It tells you the fines. It tells you, you can just scroll down pages and pages of this. They like to do that. They're self-funded, and they want to. They want to make money, and they want to put fines, and they want to find problems, okay? So, just keep that in mind. That's why lenders are taking this so seriously, and that's why we, in turn, as vendors of the lenders, from a title standpoint, have to take this so seriously. So, excuse me for that. Let's get into a little bit about the loan estimate. The loan estimate replaces the Truth in Lending Disclosure, or TIL, and the good faith estimate. It's 3 pages long, and as I said, it may be provided by either the lender or the mortgage broker. It has to be delivered, hand-delivered, or placed in the mail within 3 business days of the loan application being made. Now, for purposes of the loan estimate, business day is all days of the week except Sundays and federal holidays, and it only includes Saturdays if the lender is open for business. All right? This is a little different from the closing disclosure because God forbid that we should have the exact same rule relating to both disclosure forms. Saturdays always count for the closing disclosure, regardless of whether the lender is open for business. So remember that loan estimate, it depends on whether lender's open for business, whether they count Saturdays as a business day for closing disclosure. It always counts. Just like currently we have it as a business day for the 3-day right of rescission under the Truth in Lending Act. It's the same thing for closing disclosure. Okay. Now I'm going to give you a little example here. Here you'll have November 2015 calendar. So that's this year. This is the end of November and the beginning of December. Thanksgiving is on Thursday the 26th of this year. So let's say that the lender takes the borrower's application on Tuesday the 24th. So those 6 items that I mentioned earlier are given to the lender on the 24th. The first business day is the next day, that Wednesday. Thanksgiving is a federal holiday and not a business day, and so therefore it does not count. So the second business day then is going to be Friday, Black Friday. Third business day. If the lender is open, then that Saturday counts as a business day. So the lender on that Saturday would have to either hand deliver to the consumer the loan estimate or place it in the mail. Sunday does not count, right? So let's say that the lender puts it in the mail on that Saturday. Sunday doesn't count. The first business day after mailing is Monday. Second business day after mailing is Tuesday. And the third business day after mailing is Wednesday. Wednesday is the day that the lender can presume the borrower received the loan estimate. Now let's say the lender is closed on Saturday the 28th. Sunday doesn't count, so Monday is the third day after the loan application is taken, meaning that Monday is the first day that the lender, or the final day that the lender has by placing it in to place the loan estimate in the mail or to hand deliver it to the consumer. All right. So let's say that the lender does put it in the mail on Monday the 30th. The first day is Tuesday. The second day is Wednesday. The lender can deem the loan estimate to be received on Thursday the 3rd. Okay, so that's over a week. That's 9 days after the loan application was taken. So just keep that in mind, that before the consumer even receives the loan estimate. All right, if the lender's not open for business. Now, this slide talks about revisions to the loan estimate. So in general, when a mortgage broker or lender issues the loan estimate to the borrower, the borrower is, the lender is obligated to follow the fees that are on the loan estimate for closing. However, here are the exceptions to the rule. If any of these 6 things happens, then the lender can reissue the loan estimate. All right? Change circumstances affecting settlement charges that cause a 0 or 10% tolerance to be exceeded. For example, if for some reason on the title side it comes out that we need to get a survey and we're requiring a survey in order to insure. That doesn't happen a lot in Pennsylvania, but it could. And if that happened, that's going to be an additional cost. Once the lender finds out about that, they can reissue the loan estimate to include that charge. They can't change any of the other charges, but they can add that charge to the loan estimate. Okay? And by the way, any of these changes, once the lender receives information sufficient to establish that it's a changed circumstance, they have 3 days from receipt of that information to issue the revised loan estimate. Otherwise, they're stuck. They have to use the original loan estimate. So, number 2, change circumstances affecting eligibility for the loan, such as employment or income. So, for example, if the borrower lost his job, that's going to possibly change the eligibility or affect the eligibility of the loan. So for the loan, so the lender can then change the loan estimate to reflect that. Consumer requested change. So, for example, power of attorney. Borrower says, "Oh, by the way, I'm not going to be here for closing. I'm going to be out of the country. I need somebody else to sign these documents for me." Well, included in that will be an additional recording cost that wouldn't have been shown on the original loan estimate. So if the lender approves that and says, yeah, that's fine, they can reissue the loan estimate, including the cost of recording of the power of attorney. All right? At the time the interest rate is locked, the rate-dependent charges can change. All right? So if that happens, that's sufficient to for the lender to produce a new loan estimate. If the settlement on a construction loan is delayed, the lender can retain the right to change the fees. And then lastly, and this is important to note, the loan estimate expires after 10 days. So that means that if the borrower does not sign another form known as a notice of intent to proceed with the transaction then the lender can reissue the loan estimate or take this loan estimate off the table. It doesn't have to. It could continue with this loan estimate, but it has the right to change fees on the loan estimate if the borrower does not tell the lender that it wants to proceed with the loan. Okay. Note that the reissuance of the loan estimate does not trigger any new waiting periods, but it has to be delivered to the consumer or placed in the mail within 3 business days of receiving information establishing one of these reasons that I'm listing here. And it has to be received by the consumer 4 business days prior to closing. Also, keep in mind that a revised loan estimate cannot be issued after the initial closing disclosure is issued. So once we have a CD out there, you can't issue the lender can't issue any more loan estimates. And that doesn't mean that the CD can't change. So all the changes basically then would happen on the closing disclosure as opposed to on the loan estimate. Okay, so any changes happening later. So let's move right on to the closing disclosure then. Stephanie, are there any questions yet relating to the loan estimate?
No, we're good. We just had an audio issue, so if you don't mind, I'd like to do another quick sound check.
Sure. Can you hear me okay now?
If you guys can hear me okay, go ahead and just click on those little hand icons. Awesome. Okay, so maybe it's just Doylestown. I don't know. Looks like I'm seeing a lot of hands. So maybe our audio is back. Sorry if we had a little blip there, but it looks like it's back. So you're set to go.
Okay, good. And interrupt me if that happens again, and I'll be quiet until you get it fixed. All right, so on to the closing disclosure. The final disclosure is called the closing disclosure. It replaces the final truth in lending disclosure and the HUD-1 settlement statement. It's 5 pages long, and it's the responsibility of the lender to prepare and provide the closing disclosure, but the lender can delegate that responsibility to the settlement agent like Crosskeys. Okay, if providing the closing disclosure is delegated to Crosskeys, the lender is still responsible for the accuracy of the form. A little caveat to that, the closing disclosure I'm talking about here is for a borrower. The seller has a separate disclosure. Crosskeys is responsible for that disclosure. They are responsible for the preparation and accuracy of that form and for providing it to the lender by the day of closing for records retention purposes. All right, but when I'm talking about the CD or the closing disclosure throughout this presentation, I will call it the seller's disclosure if I'm talking about that one. Otherwise, I am talking about the borrower's closing disclosure. All right, and the lender is responsible for that. Closing disclosure has to be in the borrower's hands, so not just put in the mail, but in the borrower's hands 3 business days before consummation. Remember what we talked about, the days, what counts as business days? This is, for the CD, always includes Saturdays regardless of whether the lender is open. In another presentation, I had the question of, well, some banks are open on Sundays, so does Sunday count as a business day if the lender is open? Sunday never counts as a business day even if the lender is open, okay? So Sunday will always be the day of the lender's rest, all right? Any Saturday that's not a federal holiday would be considered a business day, though, for CD purposes, regardless of whether the lender is open for business. So this slide is going to show you 2 calendars, one for hand delivery and one for mail delivery. So at the top there, that's the beginning of November of this year. So Sunday, not a business day, right? Monday, let's say that the closing disclosure is hand delivered to the consumer. That means that we cannot close until 3 business days later. 3 business days prior to consummation, that means that Tuesday is the first business day, Wednesday is the second business day, and Thursday we can close, all right? Now, on the bottom section of that calendar, this is, again, just like on the loan estimate, the end of November of 2015. Let's say that the closing disclosure is placed in the mail by the lender on Wednesday the 25th. Thursday is Thanksgiving. So it's a federal holiday and therefore not a business day. The 27th is Friday, first business day after mailing. Saturday always counts regardless of whether the lender is open. Second business day after mailing. Sunday doesn't count. Monday is the day that you can presume that the consumer has the closing disclosure in their hands. What does that mean? All right, 3 business days prior to consummation. That means we can't close until Thursday. So in this example, It's over a week from the time that the lender places the closing disclosure in the mail to the time when we are allowed to close. Now, remember, the lender doesn't have to wait those 3, they don't have to mail it. And if the borrower receives it earlier, so say the mail is quick and the borrower gets it on Friday of that week, Friday the 27th, you don't have to wait to start counting down for that Monday. If they received it on Friday, then the first day before closing is Saturday, Sunday doesn't count, second day is Monday, and you'll be able to close on Tuesday. All right, so it all depends on the lender, it depends on the circumstances. As long as the borrower has it in their hands 3 business days before consummation, including Saturdays, okay, then we're fine. But that does mean, one thing to keep in mind here, and it's very important to keep in mind from both the title insurance standpoint and the real estate standpoint, is that the fees have to be to the lender as early as possible, because the lender has to produce a CD in good faith based on the information that it has as of the date that the closing disclosure is being produced. So that means that on the 25th, they should have the fees as close as possible, as close as can be, for a closing that's going to happen on December 3rd. And that's kind of mind-boggling. I mean, it's mind-blowing, really, when you think about the way that we handle closings today and how everything is pretty much last minute, and we're not even getting lenders' instructions sometimes until the day of settlement, let alone final walkthroughs and, final sewer readings or water meter readings. All of that, it could potentially change. And get into that a little bit further in a few slides, but I do want to point out on the closing disclosure form, you do have a form in your materials that you can take a look at. We're not going to go through every section because you don't really need to know every section, but these are some realtor concerns relating to it. First thing I want to point out is that title insurance for the owner has to be shown as optional on the new form. So the CFPB is very clear in the rule about how any title insurance or settlement-related charge is supposed to appear. First of all, it has to be in alphabetical order. All of the sections have to be in alphabetical order for that matter. But if they relate to the title insurance at all or settlement, it has to list title, space, dash, and then the description of what the fee is, and then who it's being paid to. So you're going to see it as title dash lender's title insurance 2 cross keys, right? And then it's going to list that. The other thing I want to point out with that is owner's title insurance is optional. So it has to show title dash owner's title insurance. See at the bottom there in section H, title dash owner's title insurance parentheses optional 2 cross keys, right? So the optional language may give some borrowers pause and say, well, if it's optional and the lender's not requiring me to get it, then why do I need it? The problem here, and this is where we come in, this is where Cross Keys and First American are going to come in to explain to your customer just how important title insurance is and why they really need it. If they have a title defect down the road and they didn't buy owner's title insurance because of the word optional on there, and they said, well, forget it. If it's optional, I'm not paying this extra money for it. I'm not getting it. Fine. We have them sign a waiver and everything. But if they have a title defect down the road, they paid for the lender's title insurance coverage already. They just haven't paid for their own title insurance coverages. So that means that they're going to have to hire their own attorney to defend title. And, attorneys, I am one. I'm telling you, I deal with them all the time. Attorneys love to turn around and sue everybody that was involved in the transaction. And I'm not trying to scare you with that. I'm just telling you that Cross Keys, that's their job, and that's what they're going to do. They're going to try to combat this for you because you don't want to be involved in anything relating, any kind of litigation relating to that. You want your customers not to have the issue. Even if we aren't talking litigation, you don't want them to associate any kind of have any bad blood and associate that with you. That's just bad for business for everybody. So if they buy title insurance, then any issue that may arise in the future, they're covered. And they can come and file a claim with us, and we take care of it. All right? So it is important just to point out, though. But the one good thing about the new rule is that presumably the borrower is going to, they have to have the closing disclosure in their hands 3 days before closing. So all this stuff should be taken care of. If they have an issue with that optional language, they're going to call somebody. They're going to call you, or they're going to call Cross Keys, and they're going to say, well, what's this? I don't want this fee. or they're going to call their lender and say, I don't want this fee. And then that's when we can work through and convince them of why, no, it is optional for your loan, but you really need to get it, okay? The second thing I want to point out is that the realtor's commission is no longer housed in its own section. So right now you have 700 section on the HUD-1 settlement statement where all of your fees and your commissions are. Your fees now are lumped in the other section of the form. So you're in there at the bottom with home inspection fee, home warranty fee, and then of course the title, owner's title insurance optional. The commission's showing there. All right. So just so you know where to look.
Lisa, we do have a question. I have a hand up if I can just interrupt you.
Absolutely.
So Dave Barker, I'm just going to open up your mic and you can just ask Lisa your question. All right, Dave, you're live. Go ahead. All right, Dave, if you still have a question, you can just type it in. I'm going to put your hand down. If you have a question, feel free to just type it into the chat if that's easier for you. Let me see if this is you. No. All right. Okay, go ahead.
You want me to continue, or is?
Yeah, go ahead.
Oh, okay. All right. At the bottom of page 5 of the closing disclosure, there is a section for contact information for all of the parties to the transaction. You'll see, for your purposes, that there is a section for the listing agent here and the buyer's agent. You also have to put the broker on here too. All right, and then down at the bottom, the contact information and license number. So all that stuff, make sure that cross keys, if they're doing the closing, have this up front. Or, you know, if you're the listing agent and there's some other title company involved, make sure that they have the information up front as early as possible, because the lender needs to fill this stuff in. The other thing to note here is that on the form itself, there's a questions box, and it lists and says for questions, something like for questions, you know, see below, because it's providing the contact information. But in between that, there is a link, or there's just a web address for the CFPB's website. So it's almost as if the CFPB would love it if there's an issue relating to the closing, if the consumer would go right to this consumerfinance.gov and type in a little complaint about it. And guess what? They have all of our contact information right here. Not fun. But hopefully that's not what will happen, and the consumers will see that if they do have a question, the lender's name and contact information is first. The mortgage broker, if there is one, is next. Real estate broker and agent for the buyer, real estate broker and agent for the seller, and settlement agent. Of course, there is no seller. That column would just be left blank, okay? You know, if it's a refinance transaction. So revisions to the CD. This is important to note, okay? This is very important for your business. There's only 3 circumstances that would trigger a new 3 business day waiting period, all right? So remember when I was saying that we have to get all of the information to the lender possibly a week to 10 days in advance before closing. Well, if there's a change to some of those figures and the lender has to revise and update the CD for that, it's not necessarily going to trigger a new 3-day waiting period before closing. The only things that do trigger a new 3-day waiting period are the APR becoming inaccurate, and that's really if it increases more than 1/4 or 1/8% depending on the type of loan. If the loan product changes, for example, from a fixed rate to an adjustable rate, or I was talking to a lender recently who pointed out that a lot of times something will happen where the borrowers were going to be in an FHA loan, and the property doesn't meet FHA requirements, so they have to move them to a conventional loan product. If that happens, that's going to change. You know, that would be something that would trigger the new 3-day business day waiting period. He said usually that happens earlier in the loan anyway, like before a CD would have been issued, but it could potentially happen toward the end and become an issue. Or if a prepayment penalty is added. The reason behind this is that the consumers want to, the CFPB's intent is that they want consumers to be able to really have time to think about the loan terms and decide whether or not this is the loan for them. And they figure if they give them a 3 business day waiting period before closing, then they're going to have time to decide. And if one of these 3 things changes, that's going to be the thing that's going to affect the consumer the most, probably, in the mind of the CFPB anyway. If one of the items that affects the APR changes, so the APR is wrong or increases, loan product changing, or your prepayment penalty is added. Any other change? No new waiting period. So logistically, you could still have changes at the last minute. But the thing to think about is that lenders need everything to be on the CD, and they need to approve everything. So even if Cross Keys is dealing with a lender who allows them to prepare the closing disclosure, any changes that have to be made last minute still have to be approved by the lender. They can't just make the change and then go to closing. The lender would have to see it, it have to be approved, and every little change needs to be on there. All right, so it could, even if it's not a new waiting period under the rule, because of one of these 3 items that cause a 3 business day waiting period, it could still trigger some, it could still trigger some delays, depending, especially in the beginning, until lenders get everything ironed out and how they're going to handle this stuff. Something that normally wouldn't, maybe they'll throw everything back to underwriting because they are scared of those fines that the CFPB is levying, and they are scared of retaliation from the borrowers under the rule. So, keep it in mind. Try to get as much as you can up front and help your title agents, help Cross Keys and whatever other title agent, if you're on the seller side and you're using the buyer's using someone else, try to get the information to them and to the lender as early as possible. The 3 business day waiting period can be waived only for a bona fide personal financial emergency. That never happens. It never happens, and the reason I say that is because it's the same. That's the same language that's used today under TILA for the 3-day right of rescission in a refinance transaction, and I've never seen it used. The example that they give under the rule is, okay, well, think about this. If the loan is being, if the new loan is, the proceeds of the new loan are being used to pay off an existing loan that's in default and in foreclosure and, scheduled for sale, sheriff's sale, how often does that happen where we're in that situation, in that position? That's the level that it would have to be for it to be a bona fide personal financial emergency. All right, so we're not going to see it, so don't even, we're probably not going to see it. Now on this next slide, this is what we think, how much of what goes on our final HUD-1 settlement statement today has to go on to the lender's CD. So examples here on this slide are figures that have to be provided to the lender for a TRID sale transaction that would include deposits. I'm not going to read all of them, but I'm just going to read a couple. Pest inspection fees, endorsements for the loan policy, recording fees for the buyer and seller that are related to the documents, homeowners association fees and prorations, home inspection fees, home warranty fees, real estate commissions, buyer-seller credits for title insurance or taxes and assessments, seller payoffs. All this stuff is all going to appear on the CD and appears on the HUD today, and we want to have it as early as possible. We need to include information about who's paying the charge as well. That goes on the CD. Today, even if it's a POC, every charge we have to say on the CD now who's making the payment. All right, and we have to verify the total amount due to the seller. In addition, the lender is going to need the seller's name and mailing address, real estate broker information, the real estate agent information, including ID, license IDs, email addresses and phone numbers of those parties, settlement agent companies' names and addresses, license IDs, contact names of the settlement agent's license ID. So sometimes, the agent's going to have a company, an agency license number, and also an individual who's working on it and their license number. That has to all be on there, and contact information. The lender prepares the CD. The settlement agent needs to provide this information. So even if the settlement agent's not preparing the CD, the settlement agent's still probably going to be the one that has to provide all this info to the lender. All right. The other thing I want to point out before I move on is that, the CDs right now, the CD, consider that to be the final TIL today and the HUD-1 settlement statement. Because of privacy issues, settlement agent's not going to be able to give you, the real estate professional, a copy of the closing disclosure without the borrower's authorization, the way that we hand out HUDs. So what the title insurance industry, the American Land Title Association, has done is prepare an unregulated document called a settlement statement. And we think, I really think that this is not First American's position, this is my opinion now. I really think that the settlement statement, which looks a lot like the old pre-2010 HUD form, it's like a disbursement sheet, money in, money out. I think that form is going to wind up being what closers use at closing to point everything out. That document will easily, it has all the money and all the figures on it and all the stuff like the taxes and prorations and your commissions and everything that you would need to see. It will all be on that document, and the title agent can give it to you. Whereas the CD, you don't get a copy of the TIL today. You get a copy of the HUD. So in my opinion, I think the CD is going to be another credit document, and the settlement statements, what we're going to use kind of as a map for closing. Of course, the consumer will have received the CD in advance, and the CD has to match what the settlement statement says, of course. But that's probably the document that will be more readily available to you. And if you would like a copy of it, of that form, I can certainly provide it to you as well. I can send it to Stephanie, who can share it. So what does this final timeline look like? This timeline, this count. Sure.
We have another question, so I'm just going to, Dave or Julie, I'm not sure which one of you is out there, but I'm going to unmute your mic and just go ahead and ask Lisa your question.
I have a question with regard to reporting. This is Dave, not Julie.
Hi, Dave.
I have a question with regard to reporting the exact cost of the pest inspection, the home inspection, those types of inspections, septic systems. Who's I would think it's my responsibility to get that information to the lender as those things are completed. Is that correct?
Well, is it your responsibility today to provide that information?
No, it's not.
I mean, the rule's not imposing any new obligations on you as a realtor.
Well, how will the borrower know what the cost of these fees are for the inspections?
Well, whoever is getting, I mean, whoever would normally get that is going to have to continue to get it and provide it in order to put it on there. So any fee that's related to the transaction, the lender wants to know now that it has to go on the CD. So if you're obtaining that information now, but not normally providing it to the lender or the borrower, I mean, I'm not sure how that works from your end, but the lender, yeah, you would have to either give it to the title company, whoever's doing the conveyancing, who could then provide it onto the lender in preparation of the CD, or if the settlement agent is preparing the CD, then they would add it in. It would probably be a title side thing.
Right. As representing a buyer right now, once those things are prepaid or paid for by the buyer, there's no reporting responsibility, but there is now in the future. So obviously we'll have to let somebody know about that.
Yeah, there's a section for prepaids on the form.
Okay. All right. Thank you.
All right.
Lisa, in that case, would the owner's bonus just be on the buyer to provide that?
Yeah, I mean, it's really going to depend probably on the type of loan. Like if the lender is requiring that, they're going to require you to produce evidence, the borrower to produce evidence of that. If you're not involved in that now, I don't think that you're going to be involved in that in the future. I think that will continue to be the lender saying to the borrower, you got to get me this so that I can complete my document. You know what I mean?
Right.
If you are involved in helping your customer do that, then you may want to help them by providing it to the lender. But it's not. I just want to stress that the new rule is not imposing any new obligation on you, the realtor or the real estate agent or broker, to do anything in addition besides produce your license number and contact information for the forms.
Right.
Does that answer your question?
Yeah, I think so. Yep.
Okay. Are there any others, or shall I move on?
No, you're good.
Okay. Well, here is a very compressed situation. This is highly unlikely to occur, would never happen this quickly, but what I want to point out here is the length of time of all of the waiting periods before it would even be allowed to be closed. So while we never would close a loan in 2 weeks, in this example, you can't under the rule. There is no way that you would be allowed to under the rule because of the waiting period. So this is, again, our end of November of this year. I'll never forget the date from all these presentations of when Thanksgiving is. But Tuesday, the 24th, applications received by either the mortgage broker or mortgage lender. Wednesday is the first business day after application. Thursday doesn't count because it's not a business day because it's a federal holiday. Friday is the second business day after application. Saturday, let's say that the lender is not open for business on the Saturday, so would not count for loan estimate purposes. All right, if it was open, then that would be the day that it would have to place it in the mail or hand deliver to the consumer the loan estimate. But let's say for the purposes of this example, it's not open. Sunday doesn't count. Monday, loan estimate has to be mailed or hand delivered. That's the third business day after application. So mail day 1, let's say they do place it in the mail. Mail day 1 is Tuesday. Mail day 2 is Wednesday. Mail day 3, we presumed receipt on Thursday, okay? We presume that the loan estimate is received by the consumer, all right? Now, as far as the closing disclosure, the loan estimate was either hand-delivered or placed in the mail on Monday the 30th in this example. So the earliest day the closing disclosure can be mailed or hand-delivered is the 1st, Tuesday the 1st. All right, the closing disclosure may not be issued any time before. So the lender can't skip over the loan estimate obligation and just issue a closing disclosure. It has to issue a loan estimate, all right? So say the closing disclosure is placed in the mail on the 1st. Day 1 is the 2nd, day 2 is the 3rd, day 3 is the 4th. So that Friday, we can presume that the borrower received the closing disclosure. Then we wait 3 business days before we can close. That's Saturday the 5th. Sunday doesn't, because remember, Saturdays, regardless of whether the lender's open, count for business as a business day for closing disclosure purposes. Sunday doesn't count. Monday is the 2nd day. The earliest day possible to close for an application received on Tuesday the 24th is Tuesday the 8th, 2 weeks later, okay? So we just wanted to point that out. Compressed situation. Note there, too, that the 12th, 10 days after, is when, 10 business days after is when the loan estimate expires, all right? So what I want to do for the rest of the presentation is look at questions that impact your business. I'll get into each one a little bit more closely, but I want to point out these questions for you. After we've kind of gone over the forms and some of the changes in business practices, at least for the lender and title agent, I'm going to discuss 5 questions that you as a real estate agent should be asking yourself as of the August 1st date. All right, first, are you prepared to assess the lenders you typically recommend to ensure that they are ready for transaction changes? Because TRID is a significant change to how residential transactions are closed, lenders are going to be much more involved before and after closing. So you want to make sure that you're working with a lender who knows what they're doing and who is ready for the new rule and is not going to, so that you don't have to anticipate unexpected delays relating to changes in the fees that may, for example, impact the APR. All right, initially, as lenders in closing settlement agents learn to work in the new environment, closing dates may occur longer out than you're accustomed to. So is your buyer's mortgage rate lock long enough to carry them through a closing delay? 3, have you coached your buyers to avoid making any major changes to their financing within 10 days of closing that could change their APR? Now, granted, this is probably something that you would do today, because you don't want them going out and buying a car 3 days before closing today either, because the lender may need to re-underwrite the loan. But especially after August 1st, keep that in mind and tell your buyers, do not do anything. Don't go get engaged. Don't go buy a run-up credit at K Jewelers and get engaged because it's going to affect the APR. We're going to have to re-underwrite the loan. All right. Will the buyer or seller be able to select a closing agent, or will the lender have to approve the closing agent? And finally, how will the new rule impact listing agents? So moving on to these specifically, this slide relates to the lenders. I recommend that you call the lenders that you normally refer business to, and ask them what they're doing. Ask them who's preparing the closing disclosure. Ask them whether they've migrated to software that enables them to work collaboratively with the settlement agent. They don't have to. They may do things that they're doing today. They may use secure email. They may pick up the phone and call the settlement agent for a quote. I don't know. But either way, it's important to find out what your lenders are doing. Some of the bigger lenders, all of the bigger lenders, I should say, are using new software platforms that integrate their softwares with the settlement agent software. So CrossKey's software that it uses will now be able to interface with certain lenders' software so that both of them can prepare the CD. CrossKeys will be able to input information in, and the lender can input different, the lender side fees in there in order to collaborate on a CD, a closing disclosure for closing. All right. Not all of them are doing that. Some of them are still going to continue to do what we do today, which is we may prepare it, but the lender provides its fees on its closing instructions, and then the settlement agent puts it in along with the rest of the fees. All right. Or it might be that the settlement agent provides a document with all of the fees. Maybe they'll use the Alta settlement statement I talked about earlier, and that could be the case. But I think it's incumbent upon you to find out what your lenders are doing. Find out whether the lender's trained its employees. Find out who's preparing the closing disclosure. Find out if the lender's choosing the settlement agent, or if the borrower's allowed to shop. And what about the other services, other vendors? A lot of lenders today already, but more so come August 1st, are going to be vetting title agents. So if you're using CrossKeys, you want to make sure that CrossKeys has already worked with the lender. If they haven't, you want to find out from the lender what needs to be done in order to get CrossKeys approved. A lot of them are using Alta best practices. You may have heard about this. CrossKeys will be fully functional and up to date and be able to provide a certification to lenders that require that. But not all settlement agents are in the same boat, and not all settlement agents are created equally. So you have to make sure that whatever the lender that you're working with is doing, whoever, if your buyer wants to use a specific title company, you have to make sure up front that that title company is approved with that lender, and that that they don't, and if they're not, what do they have to do to get approved? All right. Finally, what services are considered to be required by the lender and therefore held to different tolerance levels? I don't know so much whether you need to do that, but it might be good to ask the lender what things they're going to require for their loans and what things may be required, just something that the borrower wants to do. Second question is relating to the rate lock. Yes.
Just one more question. So I had a question. We know that the loan estimate expires, but the closing disclosure, does that expire?
Not really. There's nothing in the rule that would provide for an expiration of the closing disclosure. It's much like a HUD-1 today, as far as that not really ever expiring. It has to be delivered, in the borrower's hands 3 days before consummation. The borrower signing it does not obligate them to the loan, and it doesn't obligate the lender to that. But as things change, it's not like a loan estimate where you put that on and now the lender is locked into these fees. The closing disclosure can keep changing. So it doesn't have there's nothing on the closing disclosure that says basically this is it. It can't change again. So it's a little different in that vein, so I don't think that it has an expiration really.
Okay, thanks.
Sure. For this slide, we're going to talk about the rate lock a little bit. The new rule is a big change for the lending industry, and it's going to have a learning curve that could cause closing delays. All right, so I'm not even talking about the changes to the APR or the changes to prepayment penalty or loan product. I'm talking about just general learning curve delays. If the closing is delayed, then we have to look at whether or not that buyer's rate lock can tolerate the delay and allow the transaction to proceed. I think at least in the beginning, we're talking like fourth quarter here, I think that you need to expect some delays, and as such, coach your buyers about this and the lenders that you don't want your transaction jeopardized because of this rule. See if you can, get out of the short rate lock. See if they can get a longer one, 45 days, 60 days on their rate locks. The other thing to keep in mind is sale transactions, back-to-back closings. In situations where you have a back-to-back closing, there is a potential for a delay. So you, as a real estate professional, are setting the consumer's expectations here. If it's at all possible, try not to schedule them back-to-back. If in most cases, where there are back-to-back closings, it's not possible to not do that, that's fine, but you have to set the consumer, the seller, particularly expectations to say, yeah, I know that you have a settlement scheduled to buy a house on the same day with the proceeds from this, but if that doesn't if something goes wrong with the buyer's loan, that's not that may not be feasible. So they may have to have a storage place or have a hotel room booked just in case. Standard purchase contracts. I know that the Pennsylvania Association of Realtors is working on an updated form to address some of the concerns relating to this, so that's good. And just keep an eye out for that, and I'm sure Stephanie can speak to that better than I can. And if you have any questions about it, you can certainly direct them to her. On to this next slide. Is a last-minute change going to delay the closing? I think it's important that that after August 1st, just as you probably do today, that you coach your buyers to avoid making any major changes to their financing within a week or more of closing, and that could potentially affect their APR and delay the closing because, APR change, loan product change, or prepayment penalty will continue to, will cause a new 3-day waiting period. Consider the items that may impact the APR, such as the examples that are listed here. I actually have a list that's a little bit more lengthy than this that I can provide to Stephanie if you'd like to see it. But what's funny is if you ask 3 different lenders what affects the APR, you honestly in writing will probably get 3 different answers. So in my opinion, a lot of things that you can think of are going to affect the APR. So your best bet is to tell your borrower, no, don't do anything that could potentially affect it. Any of these things: points, loan amount, POC credits, paid out of closing credits, property type. And finally, set the buyer's expectation up front. If Aunt Sally wants to give them money to buy more points so that they can get a near zero interest rate 3 days before closing, they're going to need a new CD, and it's going to extend the closing date. So that's great, Aunt Sally. Thank you very much for that. But make sure that you're setting the buyer's expectations that if they're going to do that, then closing's not going to be in 3 days. We're going to change the CD because it's going to change the APR, and therefore we're going to have a new 3-day waiting period. All right. Settlement agent and lender relationships. When your buyer is using a lender you're not familiar with or a closing agent that you're not familiar with, you want to find out whether the lender has documentation requirements for the settlement agent that you're accustomed to using. So if you're using a new lender, borrower's using a new lender, find out whether Cross-Keys is approved with them. If not, what's the lender's approval requirements for Cross-Keys? What does Cross-Keys have to produce, okay, to get on the list? And that can cause closing delays as well. Try to get this stuff worked out well up front, like as soon as the agreement of sale. Find out who's going to be the lender and who's going to be the settlement agent, and try to have that worked out well in advance of closing. What about the listing side? Is there anything that the seller should be concerned about? I would say advise the seller to allow several days between closings if possible and avoid back-to-back transactions. I know that's not always feasible, but it's, you know, if it's an option, please do it. Reinforce what items are to be removed from the property. So, and if all of the inspection items have been addressed, find out that. Last minute paid outside of closing items that could impact the need for a corrected closing disclosure and a new 3-day waiting period to start. So keep all of that in mind from the listing agency side. And with that, I would see if you had any questions. And certainly, you can always contact me if you can't think of any now, but you come up with something later. I'm happy to talk to anybody about anything.
All of a sudden, they're quiet. I will speak to the forms issue. If those of you that were here the day we did this in the classroom, we had just been out at the Pennsylvania Association of Realtors meetings, and I'm on the standard forms group of the committee, and they appointed a special task force just to deal with the TRID stuff. So there are people that are going to be looking at this and working on it. They've got 2 attorneys on it, and they're very aware that some of our forms, probably more than just the agreement actually, are going to need to change a little bit. So it looks like we do have a question here.
Okay.
Lisa, we answered about the CD expiring.
Mm-hmm.
So maybe that was an old question. Anybody else? Do you guys have anything? No? Okay. All right. It looks like we are good to go.
Okay.
Lisa,
if you think of anything
do you have another question? I know we answered your earlier one. All right. Okay. Yeah, it's mostly just thank yous and that sort of thing coming in. So I think we're good to go. Lisa and I will hang out for another 2 or 3 minutes, and if you have anything else, but otherwise, feel free to jump off.
Thank you, and thanks for having me. I appreciate it.
Sure. I'm just going to wait just another couple minutes, Lisa, if you don't mind, just to see if anybody else has questions.
Yeah, I'll stay here, no problem.
Bye, guys. Thanks for coming in. Carol Richardson, you were asking about will everything be posted? Everything's actually already posted. If you go to our education library, I have Lisa's presentation up, all of her slides, plus all of her other little handouts. They're all already posted. Once this is finished processing and recording, probably sometime Friday night, I will post the webinar there as well. So you can always go back and listen